competitive round 5, and yeah, at a first impression, I would say folks didn't take into consideration as much maybe as they should have the declining sales, the fact that we were kind of in a recession. That said, Andrews clearly gained market share in spite of that decrease. Right, here we got sales of 340 million. I can't remember what they were last year. Next closest, Erie, about half, and then it drops off precipitously. Okay, you get some pretty pretty low sales for a couple of teams there. Now, good sales, really nice profit of $45 million, but an emergency loan. And Chester had an emergency loan. So Andrews had an emergency loan of $18 million. Ooh. Maybe that'll have an impact on the final score, given the score sheet. Clearly means poor financial management on their part, in spite of having a really good year. At this point in the game, I would call, these 5 contribution margins relatively low. Erie, not bad, but relatively low. This one's okay at this point. 46 would be, I would say, about right on target for what teams ought to be able to accomplish, at this point in the game. Chester used a little bit of leverage, the only team to do so, maybe because they ended up with $14 million emergency loan. I'm not sure that it was their intent to have their leverage up that high. But they did. Otherwise, again, leverage remains relatively low, quite low, as a matter of fact. So we saw 3 teams score profits, 2 teams with decent losses, Baldwin with a big loss, Digby, smaller loss, Ferris, just barely a loss. That's just barely. Ferris just can't seem to get, while their SG&A to sales percent is so nice and low, they can't seem to get their contribution margin up and going real well. Now, that said, really, you can take a look at the difference between these two, and theirs is about 18, and that's even better than Chester's, which is 17. Okay, and you can kind of take a look at that and say, yeah, that's how much is actually contributing to the bottom line. But of course, in this case, they have such small sales, and then you got to spread out your other costs, over that. This is just your variable costs, obviously here, and here's SG&A, but there's other costs that would be involved as well. Yeah, so let's scroll on down a little bit. Obviously, Andrews with a huge market share, nearly 40%. That's pretty good size. We see some changes here. Looks like Ferris continues possibly to try to sell stock, raise cash. Could be, might be that they're in a cash bind. Selling stock when your stock's as low as it can possibly go, in the real world, isn't a good idea. If you were able to, you'd buy that back. Okay, you'd buy back as much as you could. In today's day and age, with interest rates as low as they are, I'd be borrowing money as much as I could to try to buy back my stock if that were possible. But it appears maybe they're still trying to sell some stock. We see Baldwin and Digby maybe unloading some stock, and it looks like Andrews has bought back a little bit more stock. Earnings per share, not a surprise. Again, we had 3 teams that are positive. Erie's earnings per share, was their profit as big? Yeah, their profit was a little bit bigger. So, but huge, almost $20 there compared to $4 there. So double the sales, but 4 times the amount of earnings per share. And again, and it's why I emphasize that so much. Why is that? It's a combination of the contribution margin, and you want this high, you want this low. Okay, they got the highest contribution margin, and really, aside from Ferris, the lowest SG&A to sales. Okay, so a difference here of 35% versus Erie, their closest competitor, is 21%. So a huge difference. Okay, huge difference, and that's why they're able to, with twice the sales, generate 4 times roughly it's almost exactly 4 times the earnings per share. Again, not a lot of debt here, surprisingly. It looks like Ferris maybe took on a little long-term debt. Certainly other teams didn't take on a lot of long-term debt. Kind of surprising. Here Andrews has a $20 million emergency loan or thereabouts. I'm sure could easily borrow money, but chose not to. I think Chester had an emergency loan as well. Certainly not a lot of debt at this point in the game, long-term debt. By the way, you know what? I mean, what should you borrow money long term or should you borrow money short term? Long term money should be borrowed to finance things, maybe, if you don't have enough cash, certainly, but finance things like plant improvements, automation, those types of things, because they're long term investments. You should, one thing we always were taught in banking was match up loan terms with what the loan was going to be used for. So if you were buying land, you'd have a long term loan because land's a long-term asset, right, or fixed asset. And on the other hand, if you were funding inventory, that would be a short-term loan because inventory is a very short-term asset or current asset, right? So we come down. Not surprising. Look at the depreciation for Andrews. So their plant continues to grow, whether that's automation, capacity, we'll have to see later. But depreciation's, at least twice every other team. We see some changes here in inventory. Obviously, that's what got Andrews in terms of their emergency loan. They ended up probably with more inventory than what they were counting on. Plant improvements. So the two teams that are leading are also the two teams making huge investments in plant improvements. By leading, I say in terms of the profits that they showed above, sales and profits. And other teams floundering a little bit. Looks like Digby's maybe on the other hand turning some of their plant into cash for other reasons. That's possible. Some dividends paid. Chester, no wonder Chester had to borrow an emergency loan. They paid a dividend of $14 million. Wow. Had to go and look at that. A $7 dividend. Huh. Yeah, they made a little money, but paid a big dividend, and that ended up, So that entirely responsible for their emergency loan. Nothing wrong with paying a dividend. They made some money, but certainly maybe should have borrowed or something to cover that. And a dividend there. Purchase of common stock. Ferris didn't. I said they might have. Well, they did sell some common stock up here. I don't know if that's a limit or anything, but to sell that kind of common stock, that small of an amount, the cost of that would be extraordinary relative to the amount that you're getting. Very high cost, right? Your float cost to sell stock would be very high cost. A little long-term debt, so Chester did take on some long-term debt. Digby paying off some debt, interesting, maybe selling some capacity, paying down some debt. Retirement of current debt, some current borrowing just wasn't enough there. They might have had some limitations. Emergency loans, interesting. Andrews and Chester obviously with no cash. Not a lot of cash otherwise. Ferris was really close, and as was Baldwin, really to having. I think last round we had a lot of cash on the books, and now this round not so much. And again, might be not taking into consideration that decline in sales that we should have, or we did see this last round. So accounts receivable, inventory, these are reflections. Accounts receivable is just a reflection of the amount of sales, right? Unless the accounts receivable policy was changed, it's possible. Look how big, their plant is twice as big, but again, their sales are twice as much, so that's, I guess, not terribly surprising. They need to be that big. Just looking for anything else that kind of jumps out. We got some current debt. Not a lot of long-term debt. Again, I'll say that you got total fixed assets of $200 million and long-term debt of $40 million. And you can go down. Baldwin a little closer. Fixed assets of $36 million and long-term debt of $21 million. Okay. Some of these are a little bit closer, but I would say still, really, no team is leveraged on the long end. There's nothing wrong with having a reasonable amount of debt on fixed assets, especially if you don't have the cash and doing those types of things, or if you're building. Um, but we're not seeing that being used by many teams here. Total equity. So again, a big team or a big amount here of equity, but again, a much bigger company. So maybe they need that kind of plant and assets and those types of things and that kind of equity in order to sustain what they're doing. That's possible. And we come down here to our profits. Our SG&A is interesting. Yeah, they're spending 38 million. Okay, way more than any other team. Erie comes closest, but if you remember, their SG&A was only 11%, the smallest other than Ferris. So they're getting far more efficiency, far more effectiveness, and this I'm going to run right down, okay, and show you. One of the things that's for sure is I can look just at this map and tell you that they're more efficient. Okay, they've got their products positioned properly. Okay, there's a lot of other things that go into that in terms of the customer buying criteria, but I can look at this map and say, geez, they're a little bit more efficient because they've got their products, in terms of their SG&A to sales, because they got the products properly positioned. Probably looking at price and looking at age and looking at other things too. Interestingly, only team using their capacity. Otherwise, just tons of excess capacity here. Either teams are choosing not to produce because their products aren't competitive, electing to keep capacity for whatever reason. I don't know. That's up to you guys, I guess, to tell me. So. And we see some inventory, and again, that I think some decent increases in inventory. It wasn't huge, but decent increases in inventory. And again, that was probably as much a result of the decline in the sales, from the year before. And you'll see this year it's going to be a little bit more even. Now, interestingly, I see this, plant utilization just about all over 100% and close to 200%. As we saw up here. And yet look at and overtime, okay, lots of overtime, right, that they're paying. Okay, Baldwin, you come down, not using their plant, not using any overtime, and yet contribution margins are way bigger. Okay, and so you can maintain good labor costs and those things and still have good contribution margins even while using that second shift. Not only that, their efficiency, and here's things that don't get it's harder to pencil. I mean, you can sharpen your pencil and get into it big time, but they're being way more efficient. While they have higher depreciation than Team Baldwin, okay, they're getting a lot more out of their depreciation, right? On a per unit basis, their depreciation's covering this many units. For Baldwin, their depreciation's covering this many units, okay, and administrative costs and just all kinds of other costs that, again, a little tougher to pencil out but show up in the bottom line. And some inventories here and there. Nobody got stuck with a huge inventory, I would say, in any particular category. Now, it does look like the traditional segment was the hardest hit in terms of inventory. If you look down at the traditional, what do you got? 700, 11, 12, probably 21, 22, 25, 26 plus 5, so 3.1 million units. That's really, really a rough guess there. Again, here you see Ferris, really having a tough time generating some contribution margin. Okay, high variable costs, not doing a lot to drive those costs down. They might have done a few more things this round. Not really big in the automation. Not bad compared to some other teams, but certainly not competitive up here with Team Andrews. Okay. Traditional, again, next we're going to have really, really, really modest growth next year, and we've got 3.1 million units on hand, so that's going to be an interesting competition next round, right? A little tougher to see. We'll see it in the big one, but you can see a lot of products kind of bunched up. You do see here in the middle products that are probably the best position. Chester did have a fairly dominant position, selling a couple of different, okay, right? They probably got a couple. cake and coat down here and cure. Yeah, so they got three products, taking up 14, 11, and 6%, so 31% of the market is where Chester's probably being the most dominant. We might ask, what was the one I was looking at? I was looking at this earlier. I was wondering, it's down here, Bid. Bid is fairly well positioned here, right? Kind of ahead of the market, maybe a little too far ahead. I mean, that could be a bit of a negative, but it didn't sell real well. It didn't have a lot of potential. And why is that? Well, price, right? Price is one of the big deals, okay? And its price is actually over the top of that. Its age may be a little bit out of whack, but there's other products that had age profiles that were close that sold better, so I wouldn't say that necessarily. Marketing, certainly less than some of these other ones up here, but you'd have to say that price certainly was the biggest deal there. Age maybe being a contributing factor and a couple other things. So again, if you're going to sell a product in a category, you got to know what that buying criteria is in that category, and you got to start positioning your products to meet that buying criteria. Unless your goal is to get rid of that product, right? If you're just using it as a cash cow, or if you're using a life cycle strategy, and that may be the case. But if you're using a life cycle strategy, then you need to make plans for these so that still when they enter that segment, you got to have price and age and those types of things, and you also got to be driving down your cost to make it work. Low end Andrews, which is not a low cost team, but just dominating here with just the one product, but it's well positioned. All right. Age profile is a little young, okay, but spending some money on marketing, again, getting a lot out of that spending, okay, and the price profile is not the lowest, but decent, okay, so getting a little bit more out of it. Cedar has a decent product, but its age profile is a little bit tough. Ferris, not a bad product here. Its age profile is getting a little bit better. Okay, remember we want products to be a little bit older when we're talking about them in this particular category. So high end just dominated in both in all three of the high performance and size. Andrews is completely dominating. I won't spend a ton of time looking at those. Erie's the only team that's giving them really any kind of competition up here, and you can see that Erie's positioning and positioning becomes pretty important up here in the high end, right? You got position, age, MTBF's important, ideal age is down here, I guess, but price, okay, is a little more important than age actually, but you got your MTBF and then your position when that's on the performance and on the size. What do you got here? We got positioning being the key thing, then age being a big deal, and MTBF being, so again, to compete with that becomes extremely difficult when you've got these guys pushing the boundary, which is basically what customers are looking for, especially with that kind of a low age profile. So some market share data, we've kind of poured over that with questions, and there might be more questions about that. You look at the big map, and again, it kind of lets you see in the bigger sense, I guess, which teams are really being competitive here. In the high end, a few more teams, right? But here in the size, there's really three products, and here in the performance, probably really three. I'm not saying that these teams here can't pick up some sales, but it's going to be scraps probably. HR, I don't think we saw a ton of huge improvements here, but again, when we go up and we look at that contribution margin, and we look at the low costs, and Andrews isn't a low cost team, okay, but that doesn't mean that these that the strategies or the tactics are mutually exclusive. Just because you're a differentiator doesn't mean that you can't spend money, obviously, on lowering your costs, and Andrews has chosen to do that. And you see that here. They're leading here in the productivity. They were leading in the automation, and guess what? They're also leading down here in the money that they've invested in TQM. And so you just look at the labor, for example, and they got a 13-14% cost savings here, 17% basically with their HR spending, and And then with their automation up above, and I don't know what it is above other teams, but you got to figure another 10 or 20% that they're saving there, So that's why their total labor costs are probably running, 50% below in some cases, and it depends on what the other teams are doing. But I noticed up here when I was looking at it earlier, their high-end one. In fact, their high-end product here has a lower labor cost, but they've spent more money on automation there, right? It's got a lower labor cost than their traditional product, but look at those costs compared to these costs down here. Let's take acre in the low end, $5 versus 7 versus 8 versus 8.5 versus 8.22. Down here, you're getting a little bit closer. But overall, they're saving anywhere, generally speaking, from $2 to $3 per unit on 3 million units. Okay, and they're doing that using overtime, using a ton of overtime. Okay, I don't know if Ferris got that same kind of overtime. Not certainly with this product. Anyhow, they do with the feed. So with a ton of overtime, they're still saving $2 or $3 per unit on 3 million units, which is $6 to $9 million extra. Bottom line, okay, huge. Okay. So TQM, we were just glancing at that. We're about ready to finish up here, but you see some investments here. You see some other teams kind of being fairly competitive here. Erie spent quite a bit. Digby spent quite a bit in this particular round, so making some progress. Most definitely making some progress in terms of especially R&D, cycle time, administrative costs, but also in some of these material and labor costs. Here's the deal. When you get competitive, like down here in the demand increase, okay, that's wonderful. If everybody was the same, guess what? Nobody gains an advantage, right? But what's the problem here? You got one team that's got a huge advantage, another team that's got a decent advantage, and then it kind of filters on down, okay, to the teams that are, the old ranch, hanging on the hind one, I guess, would be the nice way to say it, or maybe the politically correct way to say it. I think that's all I kind of need to go over. Again, I kind of want to make these a little quicker. I'll go over the winner spreadsheet and talk about what we got to do there. Yeah, it's kind of an interesting result. So I'll show you what I mean here. Ooh, let's go this way a little bit. Let's come down. Okay. So earnings per share. Yeah, we knew Andrews was the highest there, and we knew Andrews had the highest ROE. Erie in a close second on both of those. It wasn't really a close second, but a second. Contribution margin, obviously Andrews again. So far they got the whole shebang going. Stock price, they had the best stock price increase. They had the highest profits. Cash flow, Digby won that. Andrews again had that emergency loan strategy I didn't take, and again I could have but chose not to. So Andrews the clear victor here at 98.5, but we also know that they had emergency loans, so we know they're going to lose some points there. And I don't know about Erie. They didn't have an emergency loan, so it's going to be at least 5 points difference there. Yeah, Chester also had an emergency loan. Leverage, we didn't see a lot of leverage problems, right? So nobody had any leverage issues. And then, what's the other one? Working capital. Ooh, oops. Andrews also got a discount for working capital. So now what happens? We got a tie. Between Andrews and Erie. Wow. I could be mean and break the tie, but here's what I'm going to do. Each team member, okay, for your assignment this week, you're going to get an automatic 5 points, and then you have to answer I'll probably have 4 questions in your choice. You have to answer 2 of the 4 questions then to get points to make up for that other 5. So there you have it. What an interesting result here. So in spite of the fact that they kind of dominated, did a few things here that were a little risky. Got a little penalized for that. Bummer for Andrews. Maybe good for Erie. Kind of shows that maybe this competition isn't quite over yet, although, Andrews sure had a startling lead coming into this round. So thanks, and we'll talk to you about the assignments in a bit.